So you're out there looking to buy your first house, but house prices have skyrocketed to levels we've never seen, and we have mortgage rates at decade highs. So in today's video, you're gonna learn a program that's gonna be able to reduce your monthly payment by $200, $300, $400, maybe $500 a month. Intrigued? Well, it's called the 2-1 buy down. So you're gonna see a lot of videos about this coming up because it's a program that's taking off right now. Why is it taking off and why is it unique in this environment? Well, in this environment, we know what the Federal Reserve's doing. They're trying to crush inflation. So they're driving up interest rates, they're driving up the unemployment rate, they're doing everything they can to basically crush the market. By doing so, they're basically putting home ownership out of the reach of millions. So this program is very unique and very useful in times when we know that the next year or the next 2 years from now that mortgage rates will be coming down. Well, why am I so confident that mortgage rates and rates in general will be coming down over the next 2 years? Well, the first big thing is rates are at decades high. They're not going to say it's unsustainable at these levels. But the other thing that comes into mind is recession, okay? What happens in a normal recession? Well, what is a recession? Well, basically, let's look over to Investopedia to figure this out. So not a lot of people go by these terms anymore, but this is basically what the financial news tells us what a recession is. So let's just define this. A recession is a significant, widespread, and prolonged downturn in economic activity. A popular rule of thumb is 2 consecutive quarters of a decline in GDP. Okay, that's number one. Recession typically produces declines in economic output, consumer demand, and employment. Well, we know the employment numbers, that's what the Federal Reserve's after now. But another piece of this puzzle, another indicator if there were in a recession or not, is right here. An inverted yield curve, okay, predicted the last 10 recessions. Okay, so let's look at those 2 items right there. So let's take a deep dive into those 2 items. So the first thing we come across here is the GDP. We can see the GDP throughout the years, 2018, 2019, 2020. Wow, we go all the way over to 2022. We have first quarter of 2022 is a negative. Second quarter GDP of 2022 is a negative. So that is our 2 consecutive quarters of negative GDP. Well, remember the other thing they said is the inverted yield curve. Well, it's right here. Let me show you the content where I got it from, US yield curves. And you go down through here, here's the numbers. Let's take out the 1 month, but we have 1 year at 4%, 4.1. We have the 2 year at 4.2, so that's going up. And then we have the 10-year, now it's starting to come down, and now it's starting to invert. So we go from 4 on the 1 year, 4% on the 1 year, and 3.3 on the 30 year. So let's break down these numbers. So you start out with a yield of 3% on the 1 month. We're gonna throw that out for now. So we go to the 1 year, it's coming in at 4.1. We go to the 2 year, 4.2, it's going up. And then we have the 10 year coming in at 3.8. And then we have the 30 year coming in at 3.8. Okay, so let's break this down in its yield. What does it look like is a yield curve? Well, here's the yield curve. So it's somewhat inverted. We start here, we go up, and then we come back down. That's the inversion. So now we have two triggers that are telling us we're in a recession, okay? So the next part of this is what normally happens during a recession? Well, it's right here. We can stop at the first line. What happens to interest rates during a recession? Well, interest rates typically decline during a recession as loan demand slows. So let's look at this. We know pretty confidently that the economy is going to slow down, okay? We have an inverted yield curve. We have 2 consecutive quarters of negative GDP. What else do we have to know? What else do we have to figure out to say that we're in a recession, okay? So now we see, though, in a normal recession, mortgage rates usually go down 1 to 1.5%, okay? Thus, it brings me up to the 2-1 buy down program, how unique it is and how it works. So the program is called a 2-1 buy down. Here's what it means. The first number, 2, means the initial rate that you get on your mortgage is going to be 2% lower than the benchmark rate today. Okay, I'm going to show you where rates are today so we can work on the numbers to see how much you can save based on this program. So the first thing we want to do is go over to where mortgage rates are today. So we're seeing rates today at 7.04%. All right, so let's go back to our calculator to figure out how much money are we going to actually save. Okay, so again, the definition of a 2-1 buy down is this. The 2 the beginning of this equation, means the first year that you have a mortgage, your rate is going to be 2% lower than the benchmark. And today's benchmark is 7, okay? And then the second number that says 1 in the 2-1 buy down means in year 2, your rate is going to be 1% lower than the benchmark rate. So let's go into the numbers. So if we have these numbers today, I'm looking to finance and I need a loan for $300,000. Here's what the numbers are going to look like. So we put the numbers in. So I'm looking to finance $300,000. I'm looking for a 30-year term, and the rate, as we just noted, is 7%. So that would put my principal and interest payment at $1,995, okay? So now let's see how much savings you would get by using this program. So we go down through here, and these are the calculations, and I'm gonna try to put this spreadsheet down below, a link down below in the description so you guys can have access to this to see how much money you can save. So you're gonna see across here, the initial benchmark rate or the standard rate is 7%, and that would put your payment right here, $1,995. All right. But in year 1, remember, you're going to get a reprieve of 2% off of that rate for the first year. So in year 1, your rate's going to be 5%. Your payment's going to be $1,610. That's a payment reduction of $385. And then we move down to year 2, it's going to adjust, and that rate now is going to be 6%, and that'll have a payment of $1,798, a savings of $197 a month. So you can see the monthly savings is substantial, okay? So now, what's the catch? How much does this cost me? Well, the number's right here. So let me explain how this number is created. So basically, it's simple math. You saved $385 a month here for the first year, so that's 12 months. And you saved $197 a month there, and that's also for 12 months. So we add up all those payments, and that's how much it would cost you. But you're gonna say, Dan, okay, this doesn't do me any good because I'm still having to pay $6,000 to get a reprieve in payments over the next couple years. Well, yes, but what we're gonna do is one of two things. One, we're gonna try to get your realtor to participate in this. How? We're gonna ask the seller to pay this. So here's what's going on in today's market. Sellers are starting to freak out because their houses are sitting on the market more than 15 days. And in some areas, they're hitting 30, 45, and even 60 days. So sellers are starting to panic. What's their first instinct when they start to panic? Let's reduce the price. Well, let's do this. Let's help ourselves if we're looking to place a bid on that property and say, hey, Mr. and Mrs. Seller, I'd love to buy your property, but what I'm gonna ask of you is I'll pay the price that you want, but I want a credit back for $7,000, okay? You might say, Dan, where'd you get the $7,000 from? Well, simple math. Let's go back to our calculation. You're gonna see right here, to get into this program, it's gonna cost about $7,000. We're gonna ask the sellers to pay that fee for us, okay? So another unique piece of this is, let's say mortgage rates plummet next year, okay? But you spent $6,000 to buy down these rates for the next 2 years, so you're just throwing money out the window if rates go down and you're able to refinance. Nope. This is a unique piece of this program is you'll actually get a refund. If you don't stay in this program for 2 years, any money that's sitting left over in that account is going to go back to you if you refinance. So it's a win-win. It's a win for the seller because they're able to sell their house. It's a win for you because you're having the seller actually buy down your rate for the next 2 years, making the house a little more affordable. And it's a win-win for everybody. So that is the explanation of the 2-1 buy down. I hope you find it interesting. And if you'd like to learn out more about that, or if you can get pre-approved using that program, please reach out to us. And the best way to do that is visit me at therateupdate.com. You're gonna find everything about me and my team right there and how to reach out to us. So God bless, thank you so much for watching. And don't forget to also check us out on podcasts, Dan Frio or The Mortgage Update with Dan Frio on your local podcast channel. Thanks so much for watching, God bless, see you soon, bye-bye.